Yesterday, UNH's share price fell down, and as we can see over the last week now, it is down nearly 6%. It is one that I did add to the portfolio yesterday, more shares, and the reason for this drop, as we can see here, is due to the fact that the US Department of Justice opened up an antitrust investigation into this company. Now, this is one I have talked about a lot on the channel, why I do like this, and today we're going to revisit this. As always, we'll look at the performance of the company, we'll look at how strong their company is, both on the top line basis as well as their bottom line net income. We'll also see how strong of a balance sheet this company has, comparing their total cash versus their total debt. We'll also analyze them not just versus their competitors in the industry, but we'll also talk about how they are very strong even versus the S&P 500 over the last few years. We'll also talk about the institutions if they are continuing to add shares to their portfolios, and we'll discuss some insider selling that we have noted from the Chief Accounting Officer. And as always, we'll run through the dividend safety. We'll focus on some of the financial metrics to see whether or not this should be one that you should also consider for your portfolio. We'll also run them through the valuation model to get to our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and look towards Wall Street to see what they're forecasting over the next 12 months. So let's start off by analysing how this company has performed. Now, we've mentioned over the last week they are down 6%. Year to date, so even just over the last few months, they are down. Over the last year, they're up 4.5%. Bear in mind, this doesn't include those dividends reinvested. And over the last 10 years, a very strong performance, up 543%. Now, they are currently trading in the mid to lower end of the 52-week range. They do offer a yield of 1.46%, and currently the forward PE sits at just over 18. Now, top line revenue, what we like to see, 3 to 7% growth year on year. December 2019, 242 billion reported on the top line. December 23, so their latest annual report, 372 billion. So this is a company that not only is increasing very strongly over the last 5 years, as we can see here, in fact, 50% increase to their top line, but also consistently year on year, those numbers are increasing, and that is what we love to see from any investment. Bottom line, is it a similar story? Well, 13.8 billion reported on the bottom line, and as we can see here, more than 50% growth over that 5-year period to 22.4 billion in their latest year. Again, consistency is clear here with increases to their bottom line year on year. So far, a very strong start, bottom line and top line growing very nicely. Quick look then at their health, 11 billion of cash in 2019, 25 billion in their latest quarterly report. So we can see their cash position has nearly increased by 2.5 times over the last 5 years, looking like a healthy position. Now, when we compare that to their total debt, it's at around 41 billion in 2019. It increased, as we can see here, around 50% to 62.5 billion. So we do note that not only whilst their cash position has increased 2.5 times, their total debt, which is pretty large, has increased by 50%, and we'll use this to work out what the net debt to EBITDA looks like for United Health Group. Now, we have some of their well-known competitors in the managed healthcare industry. We have Elevance Health, Humana, as well as a few well-known others. Now, over the last 5 years, UNH, on a purely 12-month basis, is up around 6%, so that includes those dividends reinvested. We see not that great, and we do see other companies in the same industry performing a lot better. CNC, Molina Healthcare, and HQY. Now, when we extend that to the last 5 years, we do see them as actually the second best performing, up 121%, with Molina Healthcare, in fact, a lot better at 194. Now, do bear in mind, though, past performance is not an indicator of future results. So, very important to understand that. And one thing that I wanted to point out, that for a very long time, United Health has in fact outperformed the S&P. Now, if we're looking purely over the last 12 months, we see the S&P up around 28%, UNH up 6.3%. But when we extend that to the last 3 years, UNH is significantly outperforming the S&P, and when we extend that to over the last 5 years, again, a very similar story. So this is one that has consistently outperformed the S&P 500, but again, this is important, and this is why I always say that past performance is an indicator of the future, because purely on the last year, the last 12 months, we see the opposite hold true. So lots of different things to bear in mind there. Current institutional ownership, well, 86%. We see 55 billion worth of institutional outflows over the last 12 months. And in terms of inflows, we see a lot more, with the largest inflows into the institutions of around 504 in Q2 of 2023. Now Q3, we see a very similar story as well as Q4, and that can also be said for Q1. So over the last 12 months, every quarter there's more inflows than outflows, and even in that latest quarter, we see the same hold true. So institutions clearly love this company, UNH. It is one that they do hold, but again, please do not copy institutions and always perform your own due diligence. Now, as always, we run it through the buys and sells, at least 100 shares over the last 1 month, just to be relevant for our discussion. Chief Accounting Officer Thomas R, we can see here, he did sell in effectively February 23rd, so roughly a week ago, 858 shares at around $525. So we can see here just under $500,000 worth. And we do see from that point the shares are down 5.6%. Now remember, with insider selling, it is not a bearish signal. They sell for many reasons, personal, private, or in fact financial reasons, whether they need the money. But as always, what we're looking for here for a bullish signal is insider buying. But again, always good to be transparent on the insider selling side as well. Now, before we jump into the dividend safety and some of their metrics, just to let you know, we have released our latest free weekly article running through investors, what they're doing in their portfolios. If you want to get access to this completely free, as well as other articles, we have a lot on the system, completely free. Click on that pinned comment below, subscribe, and feel free to read through. Now, dividend safety score 99, it is very safe. Market cap 461 billion, it is a mega cap company. Now, those recessionary metrics, if you do believe we're heading into a recession anytime soon, well, comparatively, in the last recession, they maintained the dividend. They had plus 5% average growth versus the S&P's negative 12%, and they also, as we can see here, in fact, trailed the S&P negative 63% to the S&P's negative 55%. One of the things I love with this as a dividend growth investor, 14% increase last summer, 16% on average over the last 5 years, 41% over the last 20 years. Very, very strong growth. These are one of the things that we love to see as dividend growth investors, those double-digit increases. They have also been increasing those dividends for the last 14 years consecutively. Now, dividend yield theory, as always, states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 1.51 versus 1.43, although you could also argue some reasonable valuation. On the forward P though, we are seeing it lower at 17.8 versus that 5-year average of 19.9, but do bear in mind we don't look at any of these models in isolation, and we'll conclude towards the end. And when we compare it to the sector PE of healthcare, it does sit at 17.3, so not too far off UNH. Now, in terms of the free cash flow payout, and as always, that is what we focus here on this channel. We do ignore the earnings. It is susceptible to manipulation by management through accounting. 60% is the blanket rule that I use, given the fact that I believe this in turns means management can offer those double-digit dividend increases we love to see. Now, over the last 10 years, in fact, it has been consistently below 30%. If you know this channel, you know we love consistency on a very good metric. 2023 at 27%, 2024 at 24%, lots to love here. Again, would be shocked if we don't see another strong double-digit dividend increase in 2024. Free cash flow per share, I would say this is fairly consistent, or as consistent as you could get. 671 in 2014, 2740 in 2023, expected to go even higher in 2024. So lots to love here for this company, looking at that free cash flow growth. Now, sales growth, as always, we want to see steady, moderate growth as a bare minimum, 3 to 7%. If you're looking over the longer period, looking very strong. If you're looking even just in the shorter term, double digits over the last 3 years. This is what I really love to see in companies I invest in. And numerically speaking, nearly 3 times their top line, 130 million to 372. Shares outstanding, they've done share buybacks, they've issued shares over the longer term. The net position would be share buybacks, 986, reducing it down to 938. So that is a positive to note as an investor. ROIC, as always, I personally want to see 10% or more to give me faith that management are able to effectively allocate their capital. Consistency, and that 20% in 2023 gives me a lot of hope for the future of this company. Now, Margins, what we want to see here on the operating side is around 12% for the majority of companies. Now, whilst it has been fairly low over the longer term, this isn't a worry just given the consistency of how good of a company this is in terms of their metrics and their results. But one thing I would note here is it does look like it has started to increase 9% in 2023 and 2022. If we start to see this go up even higher, then this could be a very strong sign of operational efficiency, one just to keep an eye on in the future quarters and annual report. Free cash flow margin as well, it has been increasing over the longer term, 7% in the last 3 years, looking positive as we are looking for a minimum of 5%. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, this shows us the balance sheet strength as well as dividend safety. And these are the number of years it would take the company to pay off all of their debt net of cash on hand. Not only do we want to see below 3, but the way right now we're seeing this decrease over the longer term, that is very, very positive. 0.91 in 2023. 0.79 in 2024 expected, so lots to love here with this company. They are getting a lot stronger on that balance sheet front, and we can see now why that dividend does look to have a very safe score. As always, if you're enjoying the content, values being provided, smash that like button, hit that subscribe and bell button so you're continually notified of these videos as they drop. Now let's jump into the first model we're using today, the multiples valuation model. We have companies in a similar sector and size with their P multiple. We have their average P multiplied by the earnings per share to get an intrinsic value, as we can see on this model, of lower than the market value. So we have our first sign of overvaluation, but bear in mind we don't look at any of these models in isolation. We then have the dividend discount model, some strong growth rate over the last 5 years, double digit, in fact 15.9 over this period. Forward looking, we've got a lot more conservative at 6.75. As always though, when you do grab a copy of this model, you can play around based on your estimates analysis. 642 is the intrinsic value. We have our first sign of undervaluation. We then have the DCF model with the free cash flow year on year. Forward looking, we have gone a lot lower than not just the average, but also the analyst targets. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see another strong sign here of undervaluation. So as always, the intrinsic value is just the average of these three models, and don't forget you can click on the pinned comment below if you want to grab a copy of this model to run your own companies through, to even go through this own company in the model, or even if you want to go through companies in your watch list. Now we use a margin of safety of 10% to start, and we use that if we believe it meets the criteria of a wide moat, strong financial metrics and good forward-looking data. So we keep going until we see what kind of margin of safety we're working with, and we can see it isn't quite there yet at a 20%, at 15% up to around that $510 mark. So we have a 15% margin of safety. What do Wall Street forecast? Well, they see this as a very strong buy now with a price target just under $600. And as we can see, they're anticipating upside of 21%, and they in fact see the share price will be roughly in line with our intrinsic value. As always though, do let me know your thoughts in the comments below. This is one that I did add to yesterday. It's probably one that if the share price does start to come down a little more, I will continue to add, as I do see this as a very strong company that not only just outperform the S&P 500 over the longer term, but also the majority of its competitors. As always, let me know your thoughts, whether you've also been buying or whether it's on your watch list. Don't forget, if you enjoyed today's episode, to smash that like button. As always, I'll see you on the next one, and for now, take care.